What's up everybody, Nate here, and it's obvious that the housing market in 2022 has begun to massively and dramatically slow down from its record highs set over the last couple of years. But it looks like this entire housing market slowdown is about to start accelerating.
Oh my!
Mortgage demand in the United States recently reached a 25-year low, and existing home sales are also down by over 20% on a year-over-year basis. Meanwhile, we have prices continuing to go up in many markets throughout the United States, while supply and home builder sentiment is also at a multi-year low. And if you think this is just a United States problem, well, this is actually a global issue, with the Canadian housing market currently seeing its largest price reduction for homes since the 2008 housing market collapse and Great Recession. Not only that, but the United Kingdom also has some serious issues that could be brewing for its housing market within the next few months to few years. And now many, like Wells Fargo, are predicting that the housing market is going to dramatically start coming down in 2023. But if the housing market does start to come down in ways that many analysts and experts predict that it's going to, well, this would be consistent not just with a housing market downturn, but with an outright economic recession. So today, I kind of want to give an update on what exactly is happening in the housing market and show you what we can expect to see from it, not only for the rest of 2022, but into 2023 and beyond. All right, so to kind of break down what exactly is happening in the housing market right now, we have to look at things from two different sides. We have the demand side and we have the supply side. Supply and demand in the housing market is ultimately going to determine the home affordability rate for many Americans, and it's going to show us what prices are going to be and how sales are going to look in the future. So let's kind of tackle the demand side first. When we look at demand in the housing market, you have to look at prices and you have to look at interest rates. Over the last couple of years, interest rates have been really low, and this is part of the reason why we've seen such a big housing market boom since the pandemic started. The Federal Reserve at the beginning of the pandemic dropped its benchmark interest rates to nearly 0%, and that fueled a ton of economic activity, right? There was so much new investment into homes, and there was investment in just about everything. But not only that, it meant that consumers were now able to go out and get homes at a rate that we have pretty much never seen. Think about it this way: when you go get a home, most Americans don't have the hundreds of thousands of dollars it takes to put down on a home, so you have to finance that, and financing for a home is done through a mortgage. What we have to consider though over the last couple of years is you have to sort of fit into the debt to income and other rigorous standards from the bank that you are getting the money from in order to get this home. So with that being said, over the last couple of years, the standards were essentially lowered because the banks were getting their money from the Federal Reserve, and the Federal Reserve was making it really easy for the banks to get their money. This meant that the banks didn't have to have a really high interest rate, so many Americans now have an interest rate of around 2 to 3% on their home, meaning they're going to save hundreds of dollars on their mortgage every single month. And at the beginning of the pandemic, home prices were still really low. Now, this problem has really gotten worse as home prices have gone up. Affordability has also gotten really crazy for many Americans, but it really wasn't a problem in 2021 because interest rates were still super low. Americans could buy a home and it didn't really matter what the overall home price was because you were gonna save a ton of money in your interest rate every single month. But now in 2022, the Federal Reserve is raising interest rates, and the key reason why is because of inflation. We have inflation in just about every single aspect of our economy right now, and it's the Federal Reserve's job to kind of eliminate some of that money in our economy and reduce demand. They actually want to destroy demand in the housing market so that way prices start to ease and interest rates can then come down if we see something like a recession. So now in 2022, interest rates are coming up, right? So the Federal Reserve has been slowly raising its interest rates since the beginning of this year, and now the federal funds rate is right around 4%, and it's probably going to get even higher than that because inflation really hasn't come down and we're not really seeing the big price reductions in the housing market just yet. So the Federal Reserve has to continue to raise its interest rates, but that has meant that interest rate for everyday Americans is also going up, and now they're sitting at around 7% in the United States on average for a 30-year fixed mortgage. That's a big problem because now Americans are spending on average $700 more on their mortgage than they would have for a similarly priced home in 20 2021. Many Americans simply can't afford that. So now with the interest rates going up and many Americans not able to fit into those rigorous standards set by the banks, they are ineligible to buy a home. So now millions of people can't buy homes. Now what this is causing is demand to come down. And what that can do is allow supply time to sort of catch up. Now supply can start increasing, right? Because there's not as many people buying homes, but there's still people starting to put their homes on the market. The problem is in 2022, we are not really seeing that, and it's causing some massive issues that are bleeding out into other aspects of our economy. The big issue right now has to do with the other side of the housing market, and this has to do with supply. So like I said before, supply has slightly started to increase, but it is not really going up enough, and in recent weeks, it's actually started to go back down. Overall, it is increasing, but over the last couple of weeks, we've seen some slight divots where it's decreasing once again. And this has to do with the demand side, and it has to do with overall supply. So what we're seeing is many Americans that are able to get homes are still buying homes. So people are still putting their houses on the market, and the houses that are on sale right now are still priced really, really high. We haven't seen a massive price reduction in just about any market, although some markets in the United States are going way up and some markets are starting to go slowly downwards. But what we're starting to see is that the supply side hasn't really caught up, meaning that these prices are still going to be remaining high in the housing market for an extended period of time, meaning that demand is going to continue to get lower and lower and lower. That doesn't really fix the inflation problem from the Federal Reserve or for our economy though, because if prices are still going up, then that means that nobody is going to be able to afford a house. And this could mean that the bubble in the housing market is just continuing to grow wider and wider without any signs of stopping. And the biggest reason why we're seeing supply in the United States for homes not really growing has to do with home builders. Now, home builders over the last 2 years have built a ton of homes in response to the demand. It was really easy for Americans to buy a home, so they were going to create a home and they were going to make a killing doing it because of inflation and because of the heightened demand for homes. But now in 2022, because demand is getting lower and people aren't looking for those newly built homes anymore, well, builders have stopped producing as many homes. And the bigger issue is many home builders have started to create homes and they're in the middle of home builds right now, or they're on contract to build homes that were delayed because of the heightened demand in 2021, but they're actually starting to see some decreases in those contracts and some outright cancellations because Americans are starting to lose their jobs, or they don't have as much money, or inflation is really high, so they can't afford that home anymore, leaving the builders with all of these homes, but nobody to really buy them. And this is where you have to start to look at the entire economy as a whole here, because I know this looks like it's just a housing market issue, right? Home builders are not able to sell their homes, so that's only bad for the home builder, but home building is a staple of our American economy. Think about it this way. Home builders have a lot of employees and they use a ton of resources to create a home. Now, if home building continues to decrease like it has month after month, that could mean that now home builders are not ordering as many materials, and if they're not able to build as many homes, they're not going to have as many employees, so that leads to a lot of job loss, and job loss is going to bleed into the rest of our economy because now those people who are building homes can't really buy anything. But it really doesn't end there, because now we have less homes on the market, and with fewer homes and not as many buyers, now your real estate companies are going to get hit too, because they're not going to have as many homes to sell, meaning they're not going to be making as much money, leading to cuts in that industry as well. We've actually already started to see this in 2022 from some major real estate firms. And new home investment from investors is also starting to decrease, and the homes that they do have, the flips that they have, well, they're going to start selling because of a liquidity crisis that could be coming in 2023. They have to be able to make money on these homes, and remember, over the last couple of years, real estate investment firms and investors bought up a ton of homes because of low interest rates and lots of market liquidity. Now they're going to have to start throwing those houses on the market, which could help with supply, but it also means they might be selling at a loss, leading to another massive price decrease. And again, this is all something that has been orchestrated by the Federal Reserve. They want to lead to demand destruction, so that way inflation is eliminated in the housing market. And what does inflation in the housing market going down really mean? That means that prices are going to massively start to dip. But this is not the first time that this has has happened, and it's not the first time that the Federal Reserve has stepped into the housing market this way. If prices actually do come down like a lot of analysts are predicting, and like the Federal Reserve wants in 2023, this isn't going to mean a housing market slowdown. It could mean a full-blown United States recession. The Federal Reserve in the past has done a similar thing with its interest rates. I'll kind of point to two times that it's done this: in 1981 and of course in 2008. Actually more like 2005, but we'll get there. Now, the Federal Reserve in 1981 had a unique problem with inflation as well. Inflation was a really bad issue, actually even worse than it is today. Inflation was hovering around the 13 and 14% mark. In the US just a couple months ago, it hit an over 40-year high of around 9.1%. So inflation was really high, and that led to the Federal Reserve massively raising their interest rates extremely quickly. And by the end of the 80s, the average 30-year fixed interest rate was over 10%. Now, home building and home sales in the 1980s were actually pretty stable overall, but what this ultimately created was a situation where millions of people just simply could not afford to get a home, and homes ultimately went to the people who could afford them, people who could actually get a mortgage interest rate that was over 15 to 18%. That's because the Federal Reserve had to crank up their interest rates so high that it caused an economic downturn that bled into the housing market. And a similar situation happened in 2005 to 2008. We had a situation in the early 2000s where mortgage interest rates were really low, and a lot of Americans were getting into a home. We had rampant overbuilding because people were trying to cash in on millions of people getting homes, and we had a lot of other problems like subprime mortgages, homes that were massively overvalued because the bank was giving out a mortgage to simply anybody that wanted one, so people could sell their home for anything they wanted because it didn't really matter what the price was. And yeah, that should sound really familiar because that is something that has been happening over the last 2 years. We've had rampant overbuilding and housing prices that have gotten way out of hand in fundamentals. The other thing that happened in 2008 was household finances suddenly started to deteriorate because of everything else kind of going on in our economy with the banks and also the housing market. But if you're looking at what happened back in 1981 and 2005 through 2008, there are some really key parallels, like mortgage interest rates going up way too quickly, and of course household finances starting to deteriorate and overbuilding with prices going way higher than they probably should be. What this all means is the housing market as we know it right now is probably in a bubble, and the bubble is starting to expand globally. At the end of the day, what you've got to remember is that mortgages are tied to something. Remember, this is debt that has to be paid by somebody. So no matter if it originated in Hong Kong or if it originated in Canada or the UK or the United States, all of these trillions of dollars are tied to a specific bank. And if millions of people are suddenly unable to pay their mortgage, well, now you have banks and financial institutions that are starting to fail as well. That could ultimately cause a global liquidity crisis because now all of these mortgage-backed securities and all of these banks that are supposed to be gathering all of this money from consumers who bought homes, now nobody is able to pay their debt anymore. So all of these global firms start to go down, which is only going to bleed further back into the housing market and the rest of our economy because now you have even bigger job loss. And now you have even less money circulating throughout our economy, and this is the big worry in 2022 and in 2023. Obviously, the Federal Reserve raising its interest rates brings down inflation because it brings down demand, but what that does to our economy is a whole lot more serious if they raise interest rates way too quickly and way too high. Right off the bat, consumers are not going to be able to get a mortgage anymore, but now businesses are not going to be able to invest as much into other companies, leading to ultimate job loss. And now you might have millions of people who get laid off because these businesses are starting to shrink. Now there is no money circulating throughout our economy, which means nobody's going to be able to buy a house and less people are going to have jobs. So now there's just not as much spending and demand will come back down. That will weaken the labor market, which will ensure price stability, and that is exactly what the Federal Reserve is after here. They want to keep prices stable so things don't get out of control, and they want to make sure that the labor market isn't overstimulated and there's way too many people employed because that leads to more spending in the Federal Reserve's eyes. And at the end of the day, if we truly are in a housing market bubble, then this bubble has to pop eventually. And when it does, we could ultimately see one of the biggest price reductions for homes in the United States history. Yes, even bigger than the 2008 housing market collapse. collapse. And not just in the US, but across the entire world. So what exactly can we expect from the housing market next year and into 2024? Well, it's important to mention at this point that the housing market could go in one of two ways, right? Because if inflation actually does start to come down much quicker than the Federal Reserve has anticipated, then that would actually lead them to loosen their interest rate policies. And that would mean that interest rates don't go too much higher, so they can control the housing market a lot less and allow a lot more people to get into homes. That would mean that the housing market stays pretty stable where it's at right now, and it would allow more home builders to put houses on the market, hopefully leading to, again, housing prices going up, but not at a crazy rate because interest rates will still remain pretty elevated for the extended future. But it's also going to mean that expectations are met. The Federal Reserve is not raising its interest rates, so businesses know what to do with their employees. They can keep raises coming, and builders can continue to build new homes. But obviously the opposite could happen, right? The Federal Reserve could continue to raise their interest rates because what they're doing right now isn't having that much of an effect on the housing market or inflation very generally. So they're going to have to raise their interest rates higher and higher, 6%, 7%, 8%, and even higher, meaning that we could see interest rates go up even more. Home builders are not going to want to build homes as prices are still going up for all the materials and nobody is able to really buy a home. So supply is going to stay low, meaning prices are going to stay high. Meanwhile, demand also continues to come down because nobody can afford to buy a home with a really high price and with an interest rate that probably would cross 8, 9, and 10%. And none of that really causes a global economic concern unless we start to see massive job loss and layoffs, which could bleed into the housing market, causing big foreclosures, and how the banks want to flip these houses for a much lower rate, meaning prices start to nosedive in just about every market throughout the United States and across the world. And once again, that could cause bigger and bigger issues with our entire economy because now you have global concerns with all of these different markets, from your materials market to your real estate market to your investment markets, losing trillions of dollars all at once. And that could cause some really, really big issues. Now, obviously, the housing market could go either way, and it's a really fickle kind of market to predict because there's so many other factors that go into the housing market. It's not just one simple thing. It's a variety of things that are all interconnected, not only here in the United States, but globally. So one little change could cause a domino effect, but it's important to know that all of these things are interconnected in a really complicated way. But there is no doubting it. The housing market right now in the United States and across the world is going through one of the biggest shifts that we have ever seen. And I do not know what exactly is going to be coming next, but something tells me it's gonna be big. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.